Hello and welcome back. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings, so you don't have to read the footnotes. I'm Susie, here as always with Miro. Today is December 30th, 2025, and we are talking about the retail giant that refuses to crack, Costco. Just reported their first quarter of fiscal 26.
The only place where you can buy a diamond ring and a 5-year supply of mayonnaise in one trip.
Exactly. And apparently, a lot of people did exactly that. Before we dive in, quick reminder for everyone, we're just two friends chatting about markets. This isn't financial advice, just our personal opinions. So please do your own research. So, Miro, Q1. The headline numbers looked, well, they looked very Costco. Solid?
Solid is the word, maybe even relentless. EPS came in at $4.50 a share, beating last year's $4.04. Revenue hit $67.31 billion, up about 8%. It's classic execution. Boring in the best way possible. But the thing that actually woke me up was the comp sales. Total comps up 6.4%, sure, but e-commerce up 20.5%.
20%? Wait, for Costco? Usually their website feels like it's from 1999.
It usually runs like it's from 1999. But clearly something clicked. App traffic was up 48%. So you have this massive physical retailer suddenly posting tech company growth numbers in their digital segment. That's new.
That is wild. You usually expect them to just drag their feet on digital and say, hey, come eat a hot dog. So, big beat, digital surging, and the market must be thrilled, right? What's the stock doing?
Typical sell the news action, honestly. It closed the regular session up about 1%, around $884. But after the print, it whipped around like crazy and then settled down about 0.7%. The expectation bar is it's in the stratosphere. When you're priced like a tech stock, good isn't always good enough.
The curse of competence. If you're too good for too long, people get bored. But speaking of things people aren't bored of, that membership fee hike finally kicked in, right? We've been talking about that for 2 years?
Yeah, September 1st. And you can see it immediately. Membership fee income jumped 14% to $1.33 billion. But, and here's the catch, management said less than half of that growth was from the price hike. The rest, pure volume, new signups.
So they raise the price and more people sign up. That defies gravity. Okay, so we've got a big beat, digital surging, and a stock price that's shrugging its shoulders. All right, let's dig into what those numbers actually mean for the next year.
Let's do it, because there's a weird little crack in the renewal data we need to talk about.
A crack in the renewal data, Miro, that number is usually sacred, like north of 90%, rock solid forever.
It still is mostly, but it dipped. Just a hair. U.S. and Canada renewal rates went from 92.3 down to 92.2%. Worldwide, it's down to 89.7%.
0.1%. Okay, Mr. Doom and Gloom, are we really worried about a rounding error?
In a vacuum, no, but context matters. Management explicitly said this is happening because of that surge in younger digital-first signups we just talked about. These new members, they aren't the suburban families buying a grand piano and a coffin in the same trip. They're younger, they click subscribe for a specific deal, and they churn faster. It's a mix shift problem.
So they're flirting with Costco, not marrying them yet. That makes sense. If you're suddenly growing the digital side by 20%, you're get a different kind of customer.
Exactly. It's the cost of modernizing. But look, if you ignore the membership existentialism for a second, the actual business of selling stuff is surprisingly efficient. Core-on-core margins, that's excluding gas, expanded by 30 basis points. They're squeezing more profit out of every cart.
Even with inflation, because I feel like every time I go to the grocery store, beef is up again.
You're not imagining that, and the balance sheet proves it. They recorded a $3 million LIFO charge this quarter. Last year, that was a $19 million credit.
Okay, translate the accountant speak for me.
Basically, last year falling costs were a tailwind. This quarter, rising costs, specifically in beef, cocoa, and coffee, are a headwind. Inflation isn't dead, it's just lumpy.
Lumpy, I like that. Speaking of lumpy and massive, did you see the Thanksgiving stat? The 3 days before the holiday, they sold 4.5 million pies.
That is a lot of pie.
It's 7,000 pies per warehouse. I just love that scale that reminds you that for all the digital talk, they are still the kings of physical volume.
They are, but to move that kind of volume, you need the stock. And that's the other number that made me blink. Inventory is up big, like $3 billion higher than last quarter.
$3 billion? That feels heavy. Is that just holiday stocking up?
Partly seasonality, sure, but management dropped a hint about optimizing inventory flow to get ahead of tariffs and port strikes. They're using their balance sheet as a shield.
So they're buying everything now so they don't have to pay a tariff tax later.
Smart. Smart but expensive. It ties up cash. Which brings us to the real tension in this report. You've got this massive inventory build, a digital customer that isn't as loyal as the old guard, and a management team that is aggressively changing the plumbing while the house is full of people.
All right, so the engine is humming, but they're swapping out parts at 60 miles an hour. That's the snapshot. But I want to go back to that inventory number because I think it tells a bigger story about what they're scared of.
Actually, I want to pivot away from the inventory dollars for a second and talk about how they're moving that stuff, because for the first time in a long time, Costco used a buzzword that usually makes me roll my eyes.
Oh, no. Don't tell me. Did they say Gen AI? Are we getting a Costco chatbot that hallucinates the price of rotisserie chicken?
No, thankfully. And that's the fascinating part. Ron Vatras talked about AI, but in the most uniquely Costco way possible. They aren't building a large language model to write poetry. They're using machine learning strictly for pharmacy inventory.
Pharmacy? That seems oddly specific.
It is. But think about the complexity. Thousands of SKUs, expiration dates, fluctuating demand. They deployed this system, and the in-stock rate for prescriptions hit 98%. Now they're rolling it out to gas logistics.
See, that I like. That's not tech for the sake of a press release. That's just making sure the pills are actually in the bottle when grandma shows up.
Exactly. It's unsexy operational competence. It's the same with the checkout lines. You know, the handheld devices the staff use to scan your cart before you even get to the register?
Oh, I love those people. They're the only reason I don't turn around and leave when I see the Saturday morning line.
Well, Vatras dropped a number on that. Warehouses using that pre-scan tech are seeing 20% faster checkout speeds. That is a massive throughput gain without building a single new register.
It's efficiency without automation, though. It's still a human doing it, which feels very on brand for them.
Right, but here's the constraint. They can optimize the inside of the box all day long with AI and handhelds. The problem is finding space to build new boxes.
Because everyone wants a Costco, but nobody wants the traffic jam next to their house. Pretty much.
And this is the part of the research that really blew my mind. Their CapEx guide is huge, $6.5 billion for fiscal 26. They want to open 30-ish warehouses, but the real estate is getting so hard to find, they're getting creative.
Creative how? Like floating barges?
Not yet, but in Los Angeles, they are building a warehouse with affordable housing apartments on top of it, opening in 2027.
Wait, stop. You can live above a Costco.
Yeah.
That is dangerous. I would just go downstairs in my pajamas and spend $400 on cheese.
It's the ultimate capture of share of wallet, rent, and groceries. But seriously, it shows you the lengths they have to go to penetrate dense urban markets now. They're converting an old hypermarket in France, building apartments in LA. The easy growth is gone.
That's a really good point. We look at the stock chart and think it's easy, but operationally, they are fighting for every square foot of concrete.
And that's the risk, right? The execution is flawless. The tech is finally helping, but if you can't open the doors fast enough because of zoning or construction delays like they mentioned in Spain, that $6.5 billion of CapEx starts to look less efficient.
So they have the cash and they have the demand, but they might literally run out of space to put the two together.
Precisely. It's a physics problem now, not an economics one.
Okay, that's actually a perfect place to step back. You've got AI maximizing the old stores and apartments being built on top of the new ones. So where does this leave them heading into next quarter?
So when you step back and look at the whole picture, it's kind of a strange quarter, isn't it? They're firing on all cylinders. Digital is up, margins are up, they're basically printing money, and yet the stock barely moved.
Yeah, that's the problem with perfection. When you're priced like Costco is, great is just the baseline. The market is basically saying, okay, we expect you to grow 20% online and build apartments in LA. What else you got?
It feels like they're walking a tightrope. They have to keep evolving for this new, younger digital shopper, but they can't alienate the loyalists who just want their cheap gas and hot dogs.
Exactly. And that little dip in the renewal rate, the 0.1%, is the first warning sign that the transition isn't free. It's not a crisis, but it's friction. They're trading incredibly loyal older members for digitally engaged younger ones who, well, they might cancel if the app crashes or the delivery is late.
Right. The loyalty isn't automatic anymore. They have to earn it every month. So looking ahead to the next few months, what's the big watch item for you? Is it the tariffs?
Short term, absolutely. That $3 billion jump in inventory is a massive bet. They're front-loading goods to dodge tariffs and port strikes. If consumer spending softens while their warehouses are stuffed to the ceiling, that cash flow story gets ugly fast.
So basically, they're betting on the consumer showing up, no matter what.
They always do. But it's going to be, to use management's word, lumpy. I think next quarter we'll see if that inventory bet paid off or if they just locked up a ton of cash for nothing.
Well, if they get stuck with it, I guess we'll just see even bigger stacks of jeans and air fryers in the aisles.
I'll take a discount air fryer. Why not?
All right, let's wrap it up there. Another quarter where Costco somehow manages to be boring, fascinating, and terrifyingly efficient all at once.
As always, let's see if they can build those apartments on time.
Fingers crossed. Let's close this out. And that is the show for today. Before we sign off, though, I want to take a moment to look behind the curtain. Earnings Unscripted is an experiment by a small team of enthusiasts who are exploring the frontier of AI and how it can be used to enrich us. This entire episode was created by a team of AI agents, from the research analyst and script writer to the fact-checking QA specialist, and yes, even me and Miro. We are all working together to deliver high-quality, up-to-date information in a way that would hardly be possible otherwise. We are constantly refining the process. So if you have questions or comments, please reach out at earningsunscripted@datamadness.ca or follow the project on X. Thanks for listening.
See you after the next call.